U.S. equity markets opened sharply lower Monday, and the S&P 500 is having its worst session since 2022. The sell-off started Friday following a weaker-than-expected unemployment report, reverberated around the world markets over the weekend, and flowed into the U.S. markets at open. I'd like to start by reviewing what sparked the sell-off, where we are currently, and what it means for investors. For some time, the market has been grappling with the notion that the economy is slowing and that the Federal Reserve Bank is likely to engineer a soft landing and lower rates in September. So essentially, in a display of convoluted logic, bad news was good news. A cooling economy meant lower interest rates, and that's good news for the equity and the bond markets. Many of the S&P 500 bellwether companies reported earnings the last 2 weeks, and would be fair to say that while the overall earnings trends were quite healthy, the Mag 7 companies' earnings were not quite up to expectations. Stock prices follow earnings in the intermediate to long run. Then we had a series of economic reports, most notably the Purchasing Managers' Index, which showed that manufacturing was in decline. And then Friday's employment report showed signs of a deterioration in the U.S. job market. This, combined with reports of a Chinese economy that wasn't recovering as fast as expected, sparked concerns that the global economy was headed for a recession. So bad news did become bad news. The conflicting and ever-changing views in the U.S. presidential elections have not helped investors' peace of mind. Be sure to check out an earlier video I made on whether Republican presidents or Democratic presidents are better for the markets. Spoiler alert, it doesn't really matter. Finally, to add fuel to the proverbial flames, the geopolitical situation in the Middle East also added to investors' angst, and the investors went into full-on risk-off mode. After a weak open when the S&P 500 declined over 200 points, and the more widely quoted Dow Industrials were down over 1,000 points, or almost 4% and 3% respectively. At 11:30 a.m., the markets had recovered a bit, and the S&P and the Dow were down about 2%. Semiconductor stocks experienced the brunt of the selling pressure, but have recovered somewhat. A better-than-expected Services Purchasing Managers' Index assuaged investors' concerns that the economy is headed for a recession. As is expected, the bond markets have done well, with bellwether U.S. Treasuries rallying, and the 10-year Treasury yields well below 4% at 3.8%. Let's step back from the market drama and put things in context. In the words of Warren Buffett, in the short run, the markets are a voting machine, but in the long run, they are a weighing machine. In the short run, geopolitics and other influences drive the market. But in the long run, what really matters are valuations and fundamentals, as measured by earnings growth. Valuation in the markets are admittedly not dirt cheap, but excluding the market darlings, the so-called Mag 7, the markets are fairly priced even at these interest rates. Earnings growth has been surprisingly decent. The blended earnings growth rate for the S&P 500 earnings currently stands at 11.5% versus the 8.9% expected. The blended revenue growth is 5.3%. Of the 75% of the S&P 500 companies that have reported for the second quarter, 78% have beaten earnings expectations, in line with long-term averages of about 77%. So, valuations are fair, earnings good, not a bad place to be. Expectations may have gotten ahead of themselves, especially with market darlings such as Nvidia, but a dose of reality is a cathartic process and is healthy for the markets. Finally, I'd like to quote the age-old axiom that it's time in the markets, not market timing, that makes a difference. Since 1950, the markets have returned a cumulative 324,794%, or expressed another way, about 11.5% a year on average. Yet, on the way, there have been 38 market corrections, a decline in the market of 10% or more, and 12 bear markets, a decline of 20% or more. Volatility is a way of life in the markets, and it is important to work with your financial advisor and develop a plan to meet your investment goals. Understand the risk you can tolerate and how best to execute your strategy. Matching your investment time horizon with an appropriate asset allocation allows an investor to balance volatility with returns.